Okay, everybody, good morning. Again, I wanted to introduce myself and thank you all for attending this morning. My name is James Haluschak. I'm the managing partner of SteelBridge Consulting. Our firm at SteelBridge is a boutique consultancy that focuses exclusively in private capital. We work with fund managers, limited partners, some of the software vendors, as well as third-party administrators in the business to improve operations, to deploy technology, to clean data, and a variety of other things. Really, our underlying objective is to move the industry forward with positive change. So having said that, I'll pause and pass it to others to introduce themselves. Todd Herring, one of my partners, is on the line. Todd, you want to introduce yourself for a moment?
Hey, good morning, everyone. Todd Herring, partner with SteelBridge, head of U.S. Services, and glad to join you this morning.
Great. Okay, and I want to pass it over to Chris from Preqin. Chris, want to introduce yourself?
Good morning, everyone. I'm Chris Ferguson. I'm the Chief Executive of Preqin Solutions. I've got 6 years private equity experience across my current position. Previously, I was the head of strategy for Preqin's data business. And before that, I was an investment professional at a private equity firm in South Africa. For my sins, I'm also a qualified chartered accountant through Ernst & Young. Andy.
Thanks, Chris. Thanks again, everyone, for joining this morning. Really glad to have everyone on board. My name is Andrew Kale. I'm currently the Global Head of Business Development for Preqin Solutions. So my background, I've been with Preqin now for about 5.5 years. Before my time on the solutions side of the business, I was the head of U.S. business development for their private equity entity, as well as currently managing and kind of growing the software solutions team and sales operation. So again, we're really happy to have everyone on board today. Just to kind of give everyone a bit of insight into how we're structuring the presentation. We do have a brief agenda. So what we plan to do was navigate a bit of market data, market trends that we're seeing, discuss some of the context around that from not only the Preqin Solutions client base, but also from the SteelBridge Consulting client base. And of course, we're going to tie this all together with how it lends itself to what we're seeing as far as operational excellence in the marketplace today. So I'll dive right in to the presentation. You'll all receive a copy of this after the conversations that we have today. And of course, we do want to implore those joining us today to participate as well. So if there are questions or kind of queries or points of interest that might be maybe interesting to discuss, you can use the chat function on the GoToWebinar software. That will notify the presenters only of a query, and we can incorporate that into the presentation conversation as well. So really, as we kind of kick off today, we wanted to frame the picture of what we're seeing as far as market trends and market data in the private capital markets. So it's no shock to anyone really that private capital markets, assets under management, currently sitting at a record high. So this is now approximately 4.5 trillion US dollars. Of course, it's likely even increased since the data points presented in 2016. But what we're seeing now is that this has actually doubled from the financial crisis, and we're actually seeing the possibility that this may double again within the coming 5 to 10 years. Now, we're seeing this as far as private equity taking up still more than 50% of the share of private capital markets allocations, and we'll have a bit more content to share on where we're actually seeing those allocations driven from. So the aggregate raised by asset class here. So what's actually important to note in this slide, so of course there's been a few topics of interest over the last couple of years pertinent to hedge funds underperforming capital flows in and out of that asset class. And we're not only seeing the net capital contributed to private equity asset class increasing on a net basis, we're also seeing that those allocations to private equity are increasing as a percentage of overall investors' allocations to alternatives and allocations to their portfolios at large. Now, within the context of dry powder, so this is a topic that everyone eyes very closely. Obviously, we know there's a lot of anxiety in the industry about how fund managers are putting capital to work without jeopardizing returns in the current environment for high valuations. But what we're seeing is that while dry powder is at record levels, yes, this must be taken within the context of overall deal activity. So as you can see in the current slide, we're seeing this increased dry powder, but we're also seeing that this increased dry powder is actually it's actually been flat year to year when you look at the data within the context of actual transactions happening over the 1 year to 2 year time horizon. So it'll be really interesting to see how these figures flesh out as fund managers are continuing to receive pressure from their investors to put allocations to work and ensure that they're investing their fund vehicles within the 7 to 10 year time horizon. Now, the next slide, we wanted to briefly discuss a bit about what we're seeing as far as market returns. So private market returns, currently what we're seeing here is they're softening a bit. These figures are all calculated using the net to LP cash flow data within Preqin's data set. But what we're seeing is obviously private capital markets have not been immune to the softening returns that we've seen overall in public markets. Of course, other strategies are performing better than others. It might not be a surprise that we've seen this particularly true in venture capital or in distressed debt private equity. But I think it's clear to everyone that buyout as a strategy has remained the most resilient within the context of the last few years. Now, those returns, of course, must be put into the context of broader historical performance. And what we're seeing is that longer term private capital markets continues to see continued outperformance relative to the public marketplace. So we're actually seeing that investors, what's interesting is that we're seeing investors are actually expecting about a 400 basis point spread relative to the returns that they might be receiving through public market allocations. Now, digging deeper into this and trying to understand more about preferences, we've been able to glean that really the two key drivers for attributes we've seen in private equity specifically are the risk-adjusted returns and the diversification that this asset class specifically poses to investors allocating in the private capital market space. Now, I'd want to pause before we continue, and I'd like to pose a question to Jim and the SteelBridge team. And I think I'd be curious, I know that a lot of our attendees would be curious, I mean, how are you seeing these LP expectations kind of manifest themselves within the context of fund manager behavior?
Yeah, no, that's a good question, Andy, and thanks for that. So, you know, certainly from the GP's perspective, they recognize that this expectation of outperformance is there. And it's almost to the point where with the institutional LP community that private equity and private capital is the investment of choice, and they're allocating more and more to these alternative assets year over year. And so what that does is that continues to put pressure on the GPs to react to the increased request for information, the need to improve the way they operate in order to win the mandate or win the commitment from the LPs. And frankly, that's what we're going to get into here later. But the bottom line is they recognize it, and they're not immune to it. And it's a good thing because we're you know, our industry's growing, as Andy had mentioned in the beginning. As a matter of fact, I think Andy, you mentioned there's some expectations of double growth in 5 to 10 years. I saw a statistic in Fortune that said there's an expectation within 10 years that private capital could be at 15 trillion, which is triple the growth. So GPs recognize it, and part of our point of having this conversation today is to talk with you all about what we need to be thinking about in order to keep up with these expectations. Having said that as well, I don't know if there are any questions that may have come in. We're kind of looking at our console to see. I don't think I've seen any questions, but Allison or Betty, if you being sort of the coordinators of this, if there are any questions that have come in so far, feel free to let us know and we can try to answer them. Okay.
Great. Turning specifically to the investors' views on the strategies that they feel offer the most attractive investment opportunities, clearly small to mid-market buyout funds are seen as the preferred choice, followed by VC and large and mega buyouts. And that's consistent with prior year preferences. Investors generally take a long-term view on these kind of allocations. The data does support the case that smaller funds have the potential for higher returns, although, as always, that comes with the associated volatility of committing to a smaller fund. I think what's interesting for me is that, in contrast to these stated preferences, we did see higher concentrations of capital allocated to larger funds over the past year in the wake of some big distributions. So institutional investors seem to be favoring consolidating and simplifying their PE programs in preference to taking smaller and higher yielding stakes in smaller mid-market buyout funds. Apologies, we just switched over to the screen over here. So.
All right. Just click. Are you ready to go to the next one?
Yeah. If we look at the net distributions, which is the distributions less the called capital, it's very easy to see why investors are so fond of in-market buyouts, and particularly in US and Europe. It's clearly been a fantastic 6 years. The median returns compare very favorably to other fund strategies and sizes. All that success comes at a price, though. And if we look at fund managers' evaluation of the fundraising climate today, everyone is seeing that things are a lot tougher than they were 12 months ago. You know, with Hedge probably the most bullish, but that's probably just a reflection of how bad things were for them 12 months back. That's all down to competition. So there's been no shortage of money back and distributions, but we have a record number of funds across all geographies, all strategies. You know, North America continuing its dominance in terms of market share and competition. Yeah, really just as competitive as it's ever been. If we try and put those fundraising concerns in the context of fund managers' other key challenges, we see that it ranks right up there along with asset valuations and the exit environment, both of which are closely linked. Valuations clearly a key concern across the board. That's not something that's specific to private markets. Some of this is down to the macro environment, but again, it's further evidence of that increased competition starting to put pressure on asset prices everywhere. I wonder if now is a good time to pose a question to the listeners to understand whether this kind of represents the key challenges as they see them for 2017.
Yeah, so a question to the audience, if you have any comments, again, you're able through the web console to make a response or have a response. Do you feel these are in line, for those of you on the phone that are GPs, in line with your concerns or challenges that you're dealing with? So we'll give you a minute, and Allison or Betty, if anything comes in, let us know.
Sure.
And I believe all of our attendees should have an icon with a hand. And if you'd like to raise your hand, we can unmute you and you can pose a question to the entire group as well.
Great. Having said all that about fundraising and how challenging the environment is, we spoke to a wide range of investors to try and understand what the most important criteria for them was when making future fund manager selection decisions. And aside from the the perennial and obvious kind of high scorers like returns, like the quality of the management team, like the strategy. Operational excellence is something that's emerged as a really key metric for investors when they get into the DD process. And so I'd pose the question to Jim as to why you think this is so front of mind for investors.
Yeah, it's a great question, and to be honest, it's sort of what we built our business around at SteelBridge. You know, the way I look at it is our industry really is still fairly young when you compare it to adjacent financial services marketplaces. And because of that, the way we were able to operate in the past was sort of manual, and we could rely on how well we performed as fund managers to gain the commitment from an investor. And that's really all they looked at. Well, you know, over the last 10 years, things have matured significantly, and you've got everything from financial crises to bad actors. I think we all know Bernie Madoff way too well, to good performance. And what's happening is back offices, middle offices, and even to a certain degree, the front office is becoming overwhelmed. And the only way to keep up with that is to improve operations. And investors, you know, you see it in this slide, they recognize that as well. No longer do they want to invest in a fund manager that's operating out of a quote unquote garage. They want institutional investment managers to manage their money and to give them access and transparency to the information and be confident in control of the data and of the information and frankly of the capital, the cash that flows back and forth. So I think all these things that have happened over the last, let's even call it 15 years, really have put operational excellence in the crosshairs of what we see happening in the industry and what we see as expectations from limited partners as well as frankly regulators within our segment.
Great, thanks, Jim. So just to recap on those macro trends and to talk briefly about what's going on in the industry, at the end of the day, private equity continues to grow strongly. Returns have been good over the long term. Investors, the expectations have been met, and by and large, they're planning on allocating the same or more in the future. So our industry is in a good place and is likely to continue to grow strongly. They continue to really value the mid-market, and for good reason. Returns there have outperformed other strategies, and risks haven't, or volatility hasn't been as extreme as you would expect. But all that success comes at a price. It's really competitive out there. Clearly not business as usual. There are more funds in the market than ever before. The capital is becoming more concentrated in larger firms. Valuations are a concern. If you're a fund manager about to go on the road, standing out in the crowd is going to be a challenge. And add to that, the returns have slowed over 12 months, but investor expectations are still at a level of 400 basis points over public markets. It means that the pressure is really on you guys to perform. And all of that means that operational excellence continues to grow in importance in terms of value creation for the fund manager, but also in the minds of the investor as a key attribute in funds or for their future commitments.
Great. So with that, you know, obviously we've given you a number of metrics to sort of lay the foundation for where we're going as an industry. You know, the underlying tone is fundraising is challenging. Part of that is because of the growth of the marketplace as we've described. And that's a perfect segue into this operational excellence idea that we want to talk with you about over the next few minutes and sort of give you some things to think about as well as some recommendations for addressing operational excellence. So having said that, let me go into the next few slides and sort of set the stage for what we mean by operational excellence. Because as we've said, it's a key component for investors, and in order for fund managers to stay relevant, they need to take action. Otherwise, they run the risk of being pushed aside by other fund managers who are taking action. So in terms of definition, operational excellence in the broad sense means really sort of organizational leadership and intelligence, if you will, on meeting client or investor expectations. You know, the underlying sort of theme is putting principles in place, systems in place, operations in place, tools that allow you to sustain long-term access to information to improve your investment choices and improve your LPs and again your regulators' view into what you're doing, because that's what they're asking for. So again, it's streamlining what you do and using the tools in front of you to execute on that streamlining activity. Some components that we're talking about with regards to operational excellence is things related to investor relations, making sure that personnel are equipped with tools in the training to react and respond to investor requests, whether it's during the diligence process in the beginning or on an ongoing basis when they're asking for the repetitive monthly and quarterly information or just the ad hoc questions that come in all the time. Putting infrastructure in place for your finance teams to get access to information that the management teams are requesting so that they're able to publish reports again on a monthly, quarterly basis. So having the technology and the platforms in place to get access to data as well as communicate that data out using standard methods or portals that investors are accustomed to seeing and using these days. You know, in addition, it's getting access to portfolio company information, and I think, you know, obviously that's something that is near and dear to the hearts of you fellas in terms of some of the systems you have in place, Faxon as one in particular, where fund managers want to get access to this portfolio company information. They want to alleviate some of the stress that they put on the portfolio companies with giving the information back to the fund manager. And then they also want to be able to, a certain degree, give that information down to the LPs and the regulators. So portfolio company data is critical. If you look at the chart to the right, you'll notice a statistic that's fairly telling in that the precedence that investors are putting on operational excellence is very high. And again, 10 or 15 years ago, you never would have gotten that question. It was, tell me about your returns, and I'll make a decision based on that and the team and the stability. But when it comes to your operations and your infrastructure and so forth, really was an afterthought. So we really enjoyed looking at that EY study that was published this year. So some of the key drivers within operational excellence I just mentioned, you'll see bullets on the left there. Team stability is critical. Well, when you put process and systems in place, that helps with stability because there is turnover that occurs. But if you've got that process and technology in place, that helps with continuity. Infrastructure, you want to make sure that you have good, sound compliance policies and controls, as well as proper checks for cybersecurity and data privacy. Those last two bullets there are absolutely critical to the point where there's requirements that you have a chief compliance officer designated. In some cases, it's your CFO that gets that title as well. At the larger organizations or fund managers, they're hiring CCOs, and they're putting a formal compliance policy in place. So all of that rolls up to operational excellence, and having that in place is really a critical question that's being asked during the fundraising process. So moving to the next slide and some of the data challenges that we're seeing for GPs. I mentioned portfolio company data as one of the key areas on the previous slide. We'll talk a little bit more about that in this slide. And what we're seeing is that GPs are really using data to differentiate themselves. You know, we're an information society, whether we're talking about private capital investments or we're talking about Facebook. We all have it in front of us. We all have it sitting next to us right now on the table that the three of us are sitting at. The phones are sitting there, so we want immediate access to information. And we want tools that will be able to give us this information on our phones, on our iPads, certainly on our computers. And so technology is really driving this data challenge and data expectation that we're putting on the general partners. And certainly that's a major topic for portfolio companies and the information that comes from portfolio companies. Now, conversely, when you're sitting within the portfolio company, you all of a sudden have this burden of becoming privately owned, where you've got an institutional investor requesting information from you on a monthly and quarterly basis. So we want to make sure that we have tools in place to not put undue burden on you as a portfolio company. Because look, at the end of the day, we don't want you to be in the business of giving data. We want you to be in the business of doing what you do. So finding tools and putting process in place, i.e. operational excellence, is critical on that side of the equation as well. So benefits of using some of the portfolio company data, you know, a deeper level of transparency is obvious, and it goes beyond just fund level. LPs are requesting access to this data, and we'll talk about that more in the next slide. But they want to see what's going on. Go back 10, 15, 20 years ago, LPs didn't even know what you were investing in. That is no longer the case. Regulators know what you're investing in. Regulators know how much exposure you have to a particular asset and what that does for systemic risk. So the transparency is absolutely critical. You know, another benefit of this data and operational improvement related to portfolio company information is you, being a fund manager, being able to optimize your sort of input into the asset. Portfolio company value creation is absolutely front and center today. It's no longer financial arbitrage. It's no longer just going in and levering up an investment and flipping it. That's a tactic of the past. Now being able to go in and really create value at the portfolio company level is critical, and so data allows you to do that. Financial modeling and making decisions is another benefit. When you have access to information, you can forecast and project out some things with regards to decisions related to the company. All of this, again, goes into supporting operational improvement, ultimately supporting your ability to say to investors and potential investors, you know, this is what we're doing, this is why we're doing it, which leads to an improved opportunity for raising capital. What types of data are being received? There's a whole bunch of data. I don't necessarily need to go through it all, but audited financials, annually, unaudited, quarterly, KPIs, you know, EBITDA, debt, total equity value, etc. And then general board presentations, updated cap tables. This type of information is what's being requested. And again, technology is facilitating access to that data in a more transparent way. I talked a little bit about challenges, but I want to touch upon them again. Collecting the data is tedious. So a thing to think about, and this is a bit of a recommendation, is when you're collecting data, again, putting technology, putting process in place is critical, but identifying the right resources to help you with collecting data is important. You know, there are firms out there like SteelBridge that can help you collect data. You know, there are you know, again, tools that you can use that improve that process, but really trying to alleviate some of the challenges of getting access to information needs to be thought through in detail. Another thing is identifying the right set of data to collect. You can collect 1,000 data points from your portfolio companies on a monthly and quarterly basis. I doubt you're going to look at them. So sitting down and having an open conversation within your organization, your investment committee, and honestly the management teams at the portfolio level is critical so that you're collecting the right data. Also listening to what GPs and regulators need is critical. So the forms that we need to fill out, such as Form PF or AIFMD or Bureau of Economics is now requesting data. We need to understand what data they're looking at the portfolio level and ensure that we're collecting that type of information. Let me just kind of ask you guys a question now in terms of one of your systems, Baxen, being heavy on the portfolio data collection side of things. What are you seeing from your clients when you're implementing that software as one of maybe the most important points? Is it collecting the right data? Is it putting the right process in place? Is it giving people access to the system? Is there something you can sort of convey to the audience here that is important with putting technology in place to do some of the things I've just talked about?
Sure. I'll start and maybe pass it to you, Chris. So it's really a combination of those things, Jim. Obviously, data collection and putting a protocol in place to actually achieve that is paramount. Now, the preference that we see in a lot of our clients is that it's important to actually validate the data that's come in. So one of the interesting things that we work with our clients about is actually optimizing the workflows that they would apply to data collection. So it's not simply about getting the right file, getting the right figure, ensuring that you're speaking with the right individuals at your portfolio companies. It's actually putting in place a consistent and transparent process by which you'll know that you'll be collecting the appropriate metrics every single month. Now, that's one point. I'd say a second point really sings through to the kind of theme of the day, which is a portfolio company value creation. So obviously, we're trying to drive value for our clients. This is done not only by giving them access to the data points, but also by engaging with their portfolio companies as well. So some of our clients and their portfolio companies may not actually have the most sophisticated operational protocols for their own financial analysis. We're seeing our clients tend to give access to our solution to their underlying portfolio companies as a means by which they can get organized and certainly be aware of trends in their underlying financial performance. Chris, would you want to share anything more?
No, I think you summarized that perfectly. I'm just looking at these numbers, I'm impressed by how much data people are actually receiving. And if I believe in the same report, there was a stat that said 70% of the market is still using Excel. That just screams to me what a massive data challenge there is out there. And to your point, Jim, I imagine that not all of that data is being effectively analyzed, and a lot of it is just increasing the burden on the portfolio companies for to no real value. I think the major hurdle is really adoption. So you need to do these things in stages. The first point is to get a system up and running and to get data into the system. And to do that, you need to integrate with them into the existing firm's workflow. So really get data into a software, gain the efficiencies of having a tool to report internally, to report to your investors, start building a data-centric organization. And once you get to that point, then you can move into the value creation segment and start collecting more data from your portfolio companies. That's the end goal, and really start to dig into the detail. And it's private equity's done a great job without that data so far, and with this new competition that we're seeing, this has to be the way that firms go in the future.
Yeah, good point, Chris. And actually, we received a question which really it was perfect timing, to be quite honest, with what you just said. So the question that we received is, what are some of the strategies being deployed in the industry to address the top concern of fundraising and the underlying operational excellence? Is it technology? Is it business process? More resources? What is it? And actually, what I would say is the top concern is the adoption, meaning that, frankly, technology is easy now. And I say that, and I'm actually going to, I shouldn't have said that. It's hard, but it's easy, meaning you can get access to technology by calling up the folks at Preqin and by calling up others and saying, hey, I need this type of system. Those systems are out there. Now, getting it in, that's the hard part, and that's why you call up SteelBridge to say, hey, help us get it in. That said, the hardest part and the most challenging piece of the puzzle is the adoption. It's the adoption of your teams. It's getting your team to move away from Excel. It's the adoption of the portfolio companies, if we're talking about portfolio company data. It's the adoption of the community that's going to use the data. Everybody's got to be coordinated, and I think that's an evolution. I don't think it's something that's going to happen overnight. So adoption, I think, is probably the #1 concern that you need to be thinking about, and that we need to stress when you're sitting down talking to fund managers or limited partners or management team members or whatever the case may be. We've got to get everybody on board and sort of get out of this old school thinking that we can do it the way we used to do it. It just doesn't work anymore. So thanks for that question. Okay, moving on then to the next slide, which I mentioned a moment ago, which is access. So massive topic right now. There are opinions on every side of the fence, if you will, with access to information. So LPs are saying I want secure, immediate access. GPs are saying, okay, but I don't necessarily want to open up the Pandora's box of giving you access to information. I don't necessarily want to do it real time. You know, private capital isn't necessarily a real time information business. At the same time, I want to do things that I think are beneficial for the fund as a whole, and you may not necessarily agree with. So access to information is critical. We're seeing a lot of fund managers out there, our clients, they're building portals that will allow limited partners to go in and access their data. In many cases today, that information is static data, reports that have been produced offline, published up to a portal, and it can be downloaded and viewed by the limited partner. In some cases, and I'll say very few cases, we're finding some of our larger fund manager clients are putting some live data, quote unquote, out there. Obviously, it could be dated by a week, a month, a day, whatever the case may be, but they are giving them some access to reports that they can drill into. And some of the systems that we have in our industry are providing the capability for the fund managers to deploy that feature to their limited partners. So again, a lot of debate around how much information should be out there and how timely should that information be. What you'll notice here is, again, another study from E&Y. The telling stat, and the reason that we put it into this presentation is LPs now want this information through portals. The days of sending emails with reports and statements are over. Certainly the days of mailing things are over. And so the EY study that we've published shows that 87% of LPs want to get their information through portals. So that's telling in and of itself. And honestly, it's almost a non-starter if you're a fund manager and you don't have some sort of portal. It can be as simple as box.com. It doesn't need to be super complex. It can be as complex as like an Intralinks, which is a industry leading document repository. I know some of the other folks that are out there that have software products have some element of document repositories, but having something is critical. Comment? Yeah, sure.
I mean, the other thing is it doesn't always have to be an online portal. So speaking specifically to performance data, you know, private equity has grown as a percentage of their portfolios. In the old days, they used to write a check to a big investment consultant and say, take care of this for me and call me when the money comes back. But they're becoming more sophisticated in their analysis, and a lot of them have portfolio management systems themselves. And so part of this is just being able to serve up the information in a way that is organized and digestible to their management system. So just moving away from kind of a hard copy PDF statement, we're actually being able to deliver that information. And you see it in the kind of bespoke reporting data requests that they send through, and everyone has their own template. But once you have your data from a source within a system, you can then report that any which way. So,
right.
Yeah, I see the trend in the online portals, but it's a toss-up for me as to whether they'll just be the cloud-to-cloud reporting as people talk about, and you get all the benefits around that and the timeliness around that, or whether there's kind of an intermediary layer of online portals, and there's always kind of that static element to the data, so that because it's an obvious fear that the LPs get their hands on it, and then, you know, instead of one data request a quarter, it's 20.
Right. Yeah. No, and I think it's going to be a hybrid of sort of static portals versus dynamic access to information. And I think as the industry continues to mature, the providers out there that offer one or the other are going to start to sort of meld both those features together to give access. So, good point. Okay, so let's go to the next slide. And I think an important topic related to operational excellence and really supporting the goal of raising capital is making decisions, meaning LPs making decisions on which GP to choose. And what you'll notice here is that this chart that we have from eVestment is that 73% of LPs are struggling with making decisions on which GP to make the investment in because of differing data. And so, as you can tell, that's a massive challenge for our industry. You know, as we know, these are not priced assets, so you can't just go to your Bloomberg terminal and look at things and, you know, look at some of the benchmark indicators and say, okay, X versus Y. It doesn't work that way. And so we as an industry need to move towards some level of standardization, and there are organizations out there that are doing that. One which we've highlighted here is ILPA. I'm sure most of you have heard of ILPA. It's the Institutional Limited Partners Association. It's really a trade organization looking to bring together sort of the voice of GPs and LPs. I would say that ILPA's certainly been around for a long time, and it's, in my opinion, probably the leading trade organization to create this standardization. But again, thinking about two sides of the fence, there are differing opinions on what should be included in the quote-unquote ILPA standards. Whether it's the DDQ or a cap table or whatever the case may be, there's some debate on what should be considered standard. Some GPs feel like the content that's contained within the ILPA standards is too detailed and too onerous. Frankly, some of the LPs think it's probably too much information, but then again, the LPs differ on what's important to one LP versus another LP. So I think it's an evolution. Again, we'll continue to mature and create standards that I think will be more akin to what the entire industry wants to see. You know, one of our clients, under this other solutions bullet, one of our clients, which is a massive LP fund of funds, they manage about $9 billion in assets to alternative or to private capital. They've actually taken the bull by the horns and created their own sort of DDQ or information request form. And while that helps them, and actually it hurts the industry as a whole, because now if you're a GP and you're trying to fill out the ILPA DDQ, and all of a sudden you go to this particular LP where you've got to fill out their DDQ. So now you've got a data challenge in that you're filling out 10, 15, 20, 500 different requests for information. So while it works for one particular LP, and they certainly can sort of push their weight around, it may not necessarily be the best solution for the industry as a whole. So creating standards and creating ways for LPs to make informed decisions is a key challenge, and it's an operational excellence element that needs to be thought through with regards to GPs and their organizations. Okay, moving on to the next slide. So data challenges for LPs, value in portfolio company data. Again, this goes back to the topic of how much information do you want to give to LPs? Do we want to give LPs access to underlying portfolio company information? I think, again, the answer is yes to a certain degree. It really depends, one, on probably who the LP is, and two, on you as an organization, as a fund manager, on how much information do you want to give to the community to sort of differentiate yourself from others in the space. So it's an important topic that needs to be thought through and needs to be consciously decided upon. Again, going back though to sort of ways to obtain information, and over to you, Chris or Andy, with regards to, you know, Baxen and the system that you have in place, you know, are you seeing any of your clients giving access to that system or the output of that system to their LPs?
We have the functionality to do it. We have some LPs who have a very high level access to the system, but as you mentioned, there is a lot of worry and hesitation around giving them kind of keys to the safe and,
Right.
and being able to analyze everything. You know, we can be quite bespoke about the data that the LP can actually view. So while it seems like it's a fully interactive system, there are kind of boundaries to how into the detail they can get. I would say it's probably where we're headed, but it's certainly not where we are today.
Yeah, and I think it seems with almost every client at some point or another, it's a curiosity. Can I satisfy their interest with a login, or could I actually give them access? Almost everyone that we work with has considered it or brought it up, but it seems to be less pervasive than the curiosity is.
Well, that's the thing. I think the question that GPs ask is what insight is the LP going to get from seeing this data at the portfolio company level? And obviously, I'm teeing up that thought, and I have a few comments around it. I think LPs are probably interested in understanding if you as a GP have sort of a unique skill set. What are you doing better than the person next door that I need to understand in order to make the commitment or more of a commitment to you? So they sort of want to understand a little bit about what's under the hood of why you do so well. Maybe risks. What risks are you taking that I need to be aware of and either shield myself from or embrace? And then just general visibility into the company and understanding so that you as an LP can make projections on where one investment may be going, so that for another investment you may be looking at or thinking about down the road, you know to do or to not do. So I don't know that there's a answer for what exactly do they want, but more data is what they want. We know that. And so more data allows them to do analytics, become a little more scientific in their choices. And so as you gentlemen just said, we see it, we just don't know quite where it's going to go at the moment. I mean, again, I mentioned the Bloomberg terminal before. I think that's what an LP would love to have, is the ability to just log into the terminal and look at all these different metrics that you would see on a public company for these private companies. That's not going to happen, but what's the happy medium? And again, I think the last comment I'll make, and I already made it, but I'll reiterate, it's the question of should LPs have access to this information. I think the answer is yes. I think the industry is saying yes. What level is ultimately to be seen, and I think where we'll see things play out over the next few years.
I mean, the other data challenge that they have is that they're doing more directs and co-invests, so they have this underlying
great point.
Data gathering challenge themselves that they now need to satisfy. So and higher obligations in terms of managing that investment. So yeah, I don't think the request for information is going away. Right.
Well, good. Okay, so that really takes us through the content that we were hoping to cover with you all today. I understand that there are no other questions that came from the audience. If you do have a question, feel free to hit that hand or type it up quickly. We can pause here for a second. Otherwise, you see our contact information. Feel free to reach out to us about any of the topics that we discussed today, or any other solutions or services that we can provide to you. Hopefully you found this beneficial and were able to glean a few insights related to operational excellence and some changes that you can make or at least think through, which ultimately we believe wholeheartedly will help support improved fundraising capability, improved ability to win the commitment from the investor, and then just frankly overall general improvement and positive change within your organizations. So we appreciate you all coming on the line and spending an hour with us today. And as I said, feel free to contact us with contact information on the last page. So thank you, Andy, Chris, appreciate it. Todd, I thank you for being on the line. I know I didn't let you cut in, but appreciate you helping me pull this information together. Again, thanks to everybody for joining us. Have a good day.